as I go through this workshop, I really want to highlight, there's a couple of areas that I'll be focusing on sort of quite strongly. And there's other areas which is really about the process that we want companies to look at as they're going through their capital raise. So the outcome really for this session, and let me just, the outcome for this session is, first one is to really understand what are the actual emotions of a capital raising, and make no mistake about it, is actually an emotional journey. No one ever teaches a founder or an entrepreneur. They never actually say, by the way, here's all the different emotions you're going to experience as you're going through this process. And also, what we learn is capital raising is still felt as a bit of a mysterious, dark art for most people. So the purpose of going through this session is, how do we demystify that, and how do we simplify it for most founders to understand what in essence it really is. So obviously I'll take you through the 7 steps. How you can sort of improve your own confidence around raising capital, and how you can avoid some of the simple mistakes that companies make in the process. So what I'll start off with is, I'll start off with the myths, right? And this is really important foundation for the rest of my presentation. We've got questions already. Okay, so in doing that, what's really important for us is we want you to understand the key elements. And so as a first part, the 3 daily myths that we encounter, the first one is that it takes 2 to 3 months to raise money. And it's a really interesting thing that most investors you'll meet, most corporate advisors you'll meet, they'll ask you the question of, oh, how long have you been raising for? And if you're anything over 2 to 3 months, you're made to feel like there's something wrong with your opportunity. The reality is, fewer than 5% of companies actually raise money in that time period. In fact, I've been doing workshops through Australia, Singapore, and the UK, and you find that like we'll have an audience of 100 people, and often it's just 1 or 2 that put up their hand that can actually complete a capital raising end to end within a 2 to 3 month period. It takes a lot longer than you would actually expect. The next one is that most people think that advisors and companies are pretty sophisticated in how they actually approach this, when they actually aren't. In fact, most people are still using just Excel spreadsheet and email to run their deals. And when I say most people, I'm including investment banks in this. Incredibly, it's amazing how many investment banks are still using Excel spreadsheet as a process of actually running their deal, and they've got no analytics or no visibility over what's happening in the capital raising process. And then the last one is that VCs are the main investors. And this one typically frustrates us because, we've met investment groups where they've basically, I talk about 1 in 100. I've met groups where they've invested 1 in 1,000. So the question then becomes well, if VCs are only investing 1 in 100 opportunities, who's investing into all these private companies? And that's the question we keep on asking people. And the reality is, in Australia, and I'll show you in my statistics, it's really been driven by high net worths, family offices, and sort of investment groups that often don't classify themselves as VCs. So the psychological process, and I think this is a really important part to understand, is this is what you are going to go through emotionally. The first step is, as founders, we're naturally optimistic, right? So we start out overconfident in our ability to raise capital. And this is not uncommon. In fact, it's completely normal. So we start out overconfident, and then all that happens is we start getting some rejection. Then as we start getting some rejection, we start to feel some doubt. As that doubt starts to creep in, we're going around, we're presenting to many different investors, that doubt creeps in, then all of a sudden we start to feel fear. Because as we're going around presenting to investors, bank account is going down, we're getting more pressure, you're still hiring at the same time, and you're worried about running out of runway for your capital raising. So, this becomes a high pressure time for most founders. And then all of a sudden, they raise capital and they're back to feeling bulletproof again. It's a cycle of emotions that you'll go through. And absolutely, this can all be in one day that a founder will go through. Now, in our world, when we meet investors will, and actually this was Ron as well. This is my first meeting with Ron. Most investors will say, look, Steve, why don't you introduce me to the good deals? And the funny thing I always reply is, just show me what a good deal looks like. Because every investor has their own thesis, their own ideas, their own perspective, their own background, their own value add, their own knowledge, their own networks to bring to an opportunity. So what is a good deal is very, very different for everyone. And then when we meet with companies, every company always says to me, Steve, I just want you to introduce me to the good investors. And I'm like, sure, I can introduce you to some amazing investors, but there's absolutely no guarantee that they'll like what you're doing, what you're looking to do, what your thesis is, etc. Right? So this is why we are such believers in the marketplace opportunity and also the process of becoming more visible to the areas which are of interest to you. Now, I use this example story because most of us would know Blackbird. They're one of Australia's sort of leading VCs. They've actually raised a significant fund, I think about sort of 3 to 6 months ago. What people forget is their first fund. And it was beautiful when they actually posted this because they actually divested our summit. But they had this slide, they had this text, this quote, and I thought it's absolutely relevant for anyone that's going down the capital raising process for their first time, their second time.
It will trigger a pipeline in their customer environment to do a pre-scan and pre-run. Once that is done,
join the meeting.
Wow. Okay.
Sorry, Steve. I'll just ask everyone to remain on mute for the entire presentation, please.
Thanks, mate. So Blackbird's a beautiful example of they actually started this raise, I believe, in like 2010. But what's really interesting is the metrics, right? You can see that they had over 500 meetings across 22 months to raise $29 million, right, from 97 investors. So if you break down the metrics of that, right, think about how many meetings they're doing. They're literally doing almost a meeting a day to achieve that, right? A meeting every second, probably 2 every 3 days, they're doing meetings. More than that, the average check size an investor put in is $300,000 for their first raise. Now, that's a really important thing to note, that it required that amount of effort, right? Because when most founders go into a capital raise, they think to themselves, oh, look, it's going to take me 2 to 3 months and I'll be done. It's absolutely not the case. So this is, and what's interesting is these guys were success stories before they went down this path. So here's some of Australia's most successful tech entrepreneurs. It still took them nearly 2 years and 500 meetings to raise $29 million from 97 investors. That's interesting. Catcher is another example of, obviously iProperty ended up being sold to realestate.com.au, right? But also, even when that company was a $500,000 business, right? Patrick Grove, the founder behind it, decided to set up a company called iFlix. Now, what Patrick's been successful at doing is taking businesses that succeed in the Western world and then overlaying that in Asia, right? So his idea behind iFlix was it would be the Asian copy of Netflix. He was rejected 115 times before he successfully raised, but he already built a business that was worth over $500 million at that time. And he was still receiving that level of rejection. We highlight this because we want people to understand that level of perseverance required with raising capital is really important. And also the emotional process you'll go to is fundamental. Now, for all of you, I hope you'll understand this is what is capital raising? Most people obviously just think about, oh, it's when we're attracting money into the business. What I'm referring to is the process. The process of raising money is nothing more and nothing less than a marketing and sales process. The first job that you have as a marketer is to attract potential interest. The second job is to take your investor through a sales process. The only difference is that you have between you're selling your product of your business and you're selling your shares, right? We become a lot more personal and attached to our business, right? But it's still a sales process, right? And the equivalent I like to use, actually, I'll go back. The equivalent I like to use is, I'm sure most of you have business development people or sales people that you've hired. Imagine bringing in a business development person into your business, walk him into the office, pointing to a desk over in the corner and saying, look, see that desk over there? I put a brochure on your desk. I want you to go and sell. What do you think their chances of success are? Very minimal, right? And the reason is because you've given them no processes, no systems, no CRM to use, no script, no training, no fundamental things that they need to actually succeed. So for everyone on here that is thinking about raising money, it's very unlikely that you've received, like there is actually no capital raising education, right? This is the closest you can get to, there's very little. What most people will give you guidance on is how to pitch to VCs, right? Which actually, there's so many more investors than just the VCs. And in fact, the majority of Australian companies raise their money from the high net worths and family office and also international investors as well. And I'll give you some context for my own journey shortly in a second. So just example, right? Putting that down, that is unfortunately what most founders are given to when they actually go to raise money. They don't know what they're doing. And the reason is because no one's ever taught them. So it's not necessarily their fault. There's just nowhere where you can go to get this sort of education, right? And the reality is there's no analytics for them to use as well, where if you think about not using analytics in our own businesses, it's actually madness. But the reality is no one typically uses analytics in a capital raising process. So this is one of my favorite slides. Whenever I put up this slide, I typically see people actually, when I do this in a live audience, people have smiles on their faces. Because whenever you highlight Blockbuster, most people actually have a really good memory of Blockbuster. And what's interesting about that is our memories is on a Thursday, Friday night, going with the family, going to a Blockbuster, checking out a DVD, and then going and watching. Now, what happened to them? If you think about 2004, they had 85,000 staff and 9,000 stores. By 2010, they were bankrupt. And the reason is because markets will move towards efficiency, right? All money said will move towards those things which save time, save money, and improve efficiency, right? And and it's the exact same case for your capital raising, right? What I'm saying to you is that when you're dealing with investors, you've got to think of it like the investors have ADHD and your job is to keep them interested, right? And your job is to make it as simple as possible for them to actually come to a decision. Now, this is one of my favorite slides to show, the Dunning-Kruger effect. This is what most of us found, and I'm including me as well. And just to give context to this is not because I'm not doing this presentation because I'm so amazing at raising money. I'm basically highlighting to you all the mistakes that I've made in raising capital, all the emotions I've experienced, and all the feelings that I've had in doing it. When I do a longer version of this, I actually take people through all the different ways I've been rejected by investors. Okay, so Dunning-Kruger. Now, this is all great words. This is what Dunning-Kruger effect looks like. It's massively important because you will go through this process in your capital raising. When you start, your feeling is, my business is so amazing, people should just be giving me money, right? It's amazing. Even now, with the coronavirus environment, you've still got founders that are that optimistic, they think that nothing changes whatsoever. And that is inaccurate, very, very inaccurate. In fact, the world 3 months ago on raising money is very, very different to what it is now, right? So I'll give some context as to how money changes and basically the types of investors you need to be targeting as part of your capital raise. But the most important thing for this is I really want to get you to this area, right? Where you actually feel like you know nothing, right? And this is the area that I do my best to stay in. And because the only way you can actually get better is by actually going through the process and dealing with investors. In fact, one of the things that I've learned the most is that I do my best to be in a continuous mode of speaking with investors. And I'll explain why, because it really comes from our philosophy that we approach things with. Okay, so when people go into a capital raising, their expectation is that capital raising is going to be like this. They're just going to have people throwing out money at them. They're going to be celebrating and they're going to enjoy the process. What it actually ends up feeling is like this, right? As I said, all those emotions that I've highlighted, for those people that are on the call that have actually been through a capital raise, you'll absolutely understand what I mean. Okay, so what are our core principles? Our fundamental principles for raising capital are: number 1, get ready. Number 2, stay ready. Number 3, always be raising. And 4, get to a fast yes or no. So what I mean by get ready, I'll show you in a second as part of my 7 steps, right? The always be raising one is something that's new for people to hear. There's a couple different ways you can call it. It's been referred to as the rolling close, and it's also been referred to as agile capital raising, right? Sort of reflecting off the agile development process. But the always be raising is important because effectively what that means is when you go into a capital raising, there's typically an opportunity cost because you spend so much time on it. It becomes like a second job. In fact, it can consume you. I've seen it in scenarios where companies, for me, actually, I'll give you my personal example. When we had Investec become a shareholder in our business, they consumed that, the process consumed that much of my time and that much of my energy that when the deal was finally done, I was actually reporting a decrease in my revenue in the time, because the transaction actually took 11 months in total. And I was reporting a decrease at that time. And so that was, you know, you imagine my anxiety having a new investor come on board and then reporting. Their response to me was that because of us? And it was at that point that I knew that investors know, big investors know, the toll that they can take on a small company when they're going through a capital raise, right? So you've got to be really conscious of that. Okay. Now, the next question people have, is that, okay, so I'm going to look to raise money. What do the investors look like? So we've got a database of just under 30,000 high net worth professional and sophisticated investors from several different countries. So when people kept on asking this question, we surveyed them, and we've been doing that for years now. And you can see this is a survey that we did sort of towards the end of last year. You can actually see the sectors that are of most interest to investors at that time. Now, what you'll find really interesting is that you can see how many of those investors are private and sophisticated, how many are VCs, and then also how many are family offices and how many are institutional. Now, what the highlighting of that is when you go down to the bottom area down here. Okay, now what's really important about this, we asked investors, because we started to notice a trend. We asked investors, how much do you typically invest into a first investment into a company? And then how much do you typically invest into a follow-on investment into a company? So say you're doing a capital raising now, if an investor is going to put money to you, that's their first investment into your company. If you do another round, if you do another capital raising round 1 year or 2 years later, that will be considered a potential follow-on round for an investor. Now, what's interesting about this is that if you notice, 78% of investors will invest between 0 to 250K for their first investment. Now that's really important, because what founders, when founders call our office, they'll typically say to us, Steve, I want to get an investor. We're about to do a capital raise. We want minimum check size of $500,000. We expect to raise in the next 2 to 3 months, right? And we want to get as few investors as possible. Everyone starts out with that conversation, right? There's no one that rings up and says, Steve, we want to raise money and we want to get as many investors as humanly possible onto the register as a first stage, right? But what you got to understand is if you start out at $500,000, right, for your minimum amount to invest, what that means is that 88% of investors will be excluded from participating in your first round. Right? So you're knocking out 88% of people that could potentially invest into your company. And I'll get to it sort of in a second. There's certain times in a capital raise where you really want to build momentum, and those monies, that 50K, 100K, 200K, can be really important for you in building that momentum. Well, what's really important with this stat is that when companies look to do a follow-on raise, right, investors, look at this, in the 1 to 5 million mark, that number goes from 4% to 14%, right? And you can see that it substantially increases the number of people looking to invest, right? From that 0 to 50K decreases, but it increases above 1 million, right? So it increases from 500K to 1 million, from 1 million to 5 million, and from 5 million and above, it's significantly increasing. And that's important, because when investors invest in the first round, a 50 or 100K amount, sometimes founders are disappointed. What we like to highlight to people is what they're actually saying to you is, keep me interested. This is my investment that will keep me following you. If you perform, if you shoot the lights out, I will be looking to invest larger amount. We've heard of billionaires investing 50K into companies, right? It's not uncommon. And it's an important distinction to make. So what is the actual process? What is the 7 steps? And I'll relate to how you can actually utilize this environment to your advantage as well. So the first step is a set up and frequently asked questions. Let's have a quick drink. So in the setup, right? You've got a couple different things. Now, in my case, I've actually got 3 different deal rooms. I've actually got 3 rooms that I set up, and I'll show you exactly what my room looks like so you get an understanding. I typically have pitch deck, financials, and also due diligence. Now, also, this part of the FAQ is the most practical, pragmatic thing that you can do for your capital raise, because it will save you a whole bunch of time. Okay, second step is to invite investors to your deal room, and I'll go through what that looks like in a second. So when you're inviting investors, if you're even thinking about raising capital, my suggestion to you is right now, start building a registration of interest list. As far as a first activity that you should be doing, you start to put down a list of potential investors that you want to start out having conversations with. And some of the guidance we actually give to companies is that you need to have between 10 to 40 investors in your deal room before you get one investor, right? And once again, I'll show you what that looks like as we go through. Okay, the next step, okay, is the discovering and attracting investors. Now, I'll cover this a bit more, but effectively what we like to highlight that you've got to do as part of this process is you've got to manufacture serendipity. You need to make yourself as visible as possible, that the person that ends up becoming your investor feels like it's the right time, right situation, right place for that transaction to take place, right? But the process of getting to that point, I said, is a process of manufacturing that serendipity. And effectively, that's what my job is as wholesale investor. So wholesale investor, that's effectively our role that we play with companies. But we also say to companies, they've also got to do that themselves as well. They've got to be as proactive as possible. Now, media to me is an important one. When you're utilizing media as part of your capital raising strategy, the simple job of raising money is to go from the unknown to the known, right? And that's always our job. We're trying to connect companies from being unknown to known. And how do we do that? We use things like, okay, if they're a B2B business, then we highlight their types of customers. If they've got Telstra as a customer, we'll highlight that because that's known. We've got a client recently, which is they provide a technology solution for councils, and they've got, I think, somewhere between like 5 or 6 councils as their clients. Now, when I mention that this company has got councils as a client, it saves me a whole bunch of time of basically explaining, is the product saleable? Because they've been through a procurement process with a council, and people typically know how diligent that process would have been, right? So it's moved from unknown to known. Discussions and presentations, we always recommend to make them efficient, brief, highlight the key areas, and sell the opportunity, right? In fact, we create a process for that. Okay, so this is what my room looks like. I've got a DD room. I've got a financials room, which has our last 3 years of financials. And then I've got my main wholesale investor room. This is what a DD room looks like. Now, the platform that this is on is our own platform, CRIISP. This is what we built and that we offer to our clients as part of our service, right? Basically as a subscription offering to manage their capital raising. And when people go through this process, the idea is that you can actually have some sort of analytics across your capital raising. Now, this is with the main room that I use. Now, to give you some context, when we first started inviting people to our room, out of 60 people that I invited into my deal room, only 5% asked to see financials and only 5% asked to do DD on the company, right? 90% of high net worth investors will be happy with looking at just the overview of the pitch deck, right? And their documents are in the pitch deck folder. Now, this is our frequently asked question FAQ management tool. The importance of this for me, right? If you can see, actually, I'll show it to you in a second. When we tell companies to go and set up their frequently asked questions, you can see that in the top 4 questions, the questions are really focused around business model and valuation. So what's going to happen is when you go to raise money, you're basically going to answer the exact same question over and over, day after day, sometimes in different ways. So I got really frustrated to the point that we actually just built software to manage that, right? And to do it in such an intelligent way, because the objective that we're always thinking about is how can we help companies save time, save money, and improve efficiency? Right? So if you can set this up right, what happens is if you've been through a capital raise, sometimes you can spend 3 to 5 hours with potential investors. when you set up this process, it will bring that down to between half an hour to an hour, right? And the reason is because they don't have to ask all the questions that other investors have asked before them, right? Because it's all about efficiency. And I'll show you my examples. So here's an example of an invitation. Now, look, part of what we've built as part of our process is we actually provide our clients with these sort of templates, because what's crazy is when we've been working in this space, I've actually seen companies in a first email to an investor send a 4-page long email with 5 documents attached. Their chances of getting any of that opened or looked at is 0. And that's important to know. So when we do this sort of stuff, it's trying to make it easy for the investor as well. Once again, the save time, save money, improve efficiency also relates to investors. So the invitations has to be clear. It has to highlight the round that you're doing. It has to highlight why you're actually raising the money. It also has to highlight what their process is for them so that they know what they need to do. Okay, so that was step 2. Now, step 3, attracting and discovering investors. Now, we're almost about 30 minutes into the, 30 minutes into the presentation, right? Maybe less. Anyway, this is the part which most people want to hear about, is the attracting and discovering investors, right? They don't think about all the other things beforehand. So when you're thinking about this, here's my simple suggestions. First one, build a registration of interest list. Second, a board and advisor networks are always relevant, right? It's amazing if you don't have a board yet, then obviously I highly recommend to start the process of building one, but your board and advisor networks become incredibly important. Suppliers and customers, it's amazing how many companies don't think about inviting their suppliers or encourage their suppliers and customers to participate in a capital raise. Now, there might be a strategic way on how you do it, but I know from my own case, I have both. I have a customer who initially bought our services that has now become a shareholder. And I've also got a supplier who was actually started out as our lawyer that has also become a shareholder. I've also got customers in the sense of investor subscribers that are now shareholders in WI. In fact, for us in the last 12 months alone, to give you some perspective, we had shareholders come on board from 5 different countries, across Vietnam, across New Zealand, France, Singapore, and also Canada/China, onto our register, right? And that's all just from following this process. Okay, existing networks and networks of friends. So existing networks, especially commercial networks, are powerful. Networks of friends. Now, I personally haven't tapped into my friends' networks. I'm not the biggest advocate for tapping into the Triple F fund, the Friends, Family, and Fools network, right? My belief is always that your investors should be at least somewhat relevant to your business for going forward. And to give you some context right now, in the actual capital raising space, is the most important time to understand that what happens in this area is that basically the punt money stops and investors become more strategically aligned with their business. So what happens is investors, when they're looking to invest, what they're analyzing is how they can leverage the business in some way, right? Or how they can add additional value to the business. So unless they can add value, or unless your business can be leveraged in some direction, it makes it a lot harder for them from an investment decision. So what happens is investors start to narrow their focus of what they're investing, and they become more strategically aligned. And that is such an important distinction for this environment. I said, every day I'm getting asked the question of, are investors still investing? And my reply is always the same. Are you insane? This is the market that investors have been waiting for, especially ones that got cashed up over the last 1 to 2 years and sitting in cash. This is a buy market for them. This is such a unique opportunity. This is a once in a decade opportunity for them to be getting into businesses, investing into businesses at prices which for them will feel a lot more realistic and in line with what they should be, right? So understand that as a company, you've got to understand that the way you're positioning your offering has to be much more aligned to what the investor is looking for but make no mistake, it is a buyer's market. Does that not mean that good valuation can be achieved? Absolutely, they can be achieved. For some companies, they may have to discount their share price to get that money on board. It depends. We're highly recommending investors not to be predatory in this process, right? But the reality is valuations on some businesses will come down, right? My suggestion to all of you listening is the more strategic and aligned you can find your investors, it's going to work out much better for you going through this process, because then you won't have them suddenly putting the brakes on going forward. But absolutely expect to negotiate, and absolutely expect sort of nuances in the deal making side. Okay, so discussions and presentations. Okay, so this sort of stuff, and someone asked about providing the slides. I said, look, some slides I'm happy to help share if that helps. Effectively, what you've got to do is you've got to provide a process. Now, when you're creating your visibility, you've got to, being part of meetups, being part of, like, we've now started doing virtual showcases as for what we do. And the craziest thing for us was our first virtual showcase, we had 1,100 views of it. So in doing that, you've got to make yourself more visible, right? Once again, going from that unknown to known, it's no different to a marketing exercise. Do your best to, if you're going to get media, don't bother getting media unless you're actually raising money, because getting media for your own ego is not useful at all. And we see companies do that all the time, right? If you're going to get media, try and leverage off that media coverage in such a way that you can utilize that to actually raise money, right? And social media is powerful. For most of us, LinkedIn can actually be one of our most powerful weapons. I know for me, I've absolutely leveraged LinkedIn as part of a capital raising. I've never promoted my capital raising on LinkedIn, but I've absolutely had investors become interested in my business from LinkedIn, right? And then I just drive them through my deal room and drive them through my process. Now, if you notice down the bottom, I'm saying that what you need to try and do, and this is one of the dances, right? The dance of capital raising is a dance of momentum and a dance of pressure. So you want to generate momentum and you want to try and manufacture pressure in the process. The real skilled deal makers have that ability to do that. So I'll move through these fairly quickly because we're sort of running out of time really fast. Activity tracking, momentum creation, and then the communications. So what's beautiful about this for me is if I was to ask you what investors find most interesting about your business, you could give me a perspective, you could tell me, but the only truth is, the only facts you can, is if you've got some sort of analytics. Whatever anyone else people tell me, it's just their perception. It's what they, you know, we've all got selective memories, right? We take away from conversations whatever we want to take away. For me, I've actually got data proof. This number down the left-hand side, that is exactly how many times investors have clicked on that question, right? So things that I thought were really interesting to investors are actually sitting on the bottom of this list, which I find absolutely crazy, right? And you can see that valuation, references, all that sort of stuff is super important to the investors. This is every time someone makes an action, the platform actually tracks it, and the data, and there's actually data which comes through from the platform. The idea behind this is we want to get to a point where the platform knows when there's about to be a successful transaction before it actually takes place. Here's an example of an investor that went into my deal room. You can see how I can see all the different activities that they have done. What's important about that for me is that I know what's of most interest to them. I know what they want to have discussions about. I know what's important, what areas are important for them before we even have a conversation. This is how I take a 3-hour conversation down to half an hour. Now, when you think about it, if you're going to have 50 conversations with investors over a course of a year, that's a massive amount of time saving for a company. How do you create momentum? Right? This is how. When you go through your launch process, we suggest you keep your capital raise open for literally between 30 to 60 days. 60 days is a much more workable time frame. Virtual showcases are important. Webinars are important. Conference calls are important. Progress updates to your investors are important. Providing webinars, doing all this stuff I've done. All this I've been part of how I actually generate momentum and interest for actual capital raise, right? Because I said momentum and pressure are two of the hardest things to actually create. Here's some example of my communications. I won't spend too much time on this, but you can get the idea. It's really simple, really clear, and I'm just making it so it's really straightforward from the investor side. I'm not sending them 4-page long emails. Now, just as a key area to talk about at the end, what is the investor psychological process? So first one is loss aversion. So when an investor is looking at investing into your business, they're thinking about all the different ways that they can lose. Now, there's 4 main ways. 4. Basically, the first one is money, right? Everyone knows that one. Second one is time, right? That they spend looking at your details and getting involved with you. Third one, right, is reputation, credibility. Fourth one is opportunity cost. So the 100K, the million, the 5 million, whatever it is they invest into you, they could have invested that into any other opportunity that's being presented to them. So there's an opportunity cost that they could have lost. So that's the loss aversion part. Next one, no investor wants to be the first one in and no one wants to miss out. So what's important about that for you to understand is that goes back to the momentum generation and also putting pressure on the actual process. After you start to get some investors on board, right, then the bandwagon effect starts to kick in. And that's important. What's so nice for me now is that when I'm talking to potential investors, I can mention that I have Investec as an investor, which is an investment bank. I've got a VC as an investor. And all my other shareholders have a background connected to private equity, venture capital, funds management, wealth management, and also angel investment as well, right? So from their perspective, you know, it's said as humans, we're always trying to, how can I say it, simplify our decision-making process, right? And that helps when you've had other investors going because you can refer to them. So as bandwagon effects get created, then the last thing is FOMO, right? The fear of missing out. So as you cross that sort of 50, then you get to 70%, 80%. Then what investors get to worry about is they worry about missing out on the opportunity altogether, right? So that's when the fear of missing out comes. And I learned this from watching the Shoes of Prey capital raise. I think it was like 2012. As soon as Mike Cannon-Brookes went in, every other investor followed him, right? Because they don't want to be the first ones in, but they don't want to miss out. And then the bandwagon effect kicked in. So this is a natural psychological process for investors. This, most investors, when they're investing into you at the early stage, they're looking for a 5 to 10 times uplift. And if you're a bit of a later stage company, one of the most popular areas for raising is it's called the pre-IPO. So the pre-ASX listing stage. So it's typically about 12 to 18 months out. The reason investors like it is because there's an assumption that there's going to be a 20 to 30% uplift. And obviously there's going to be an exit when the company lists on the capital raising, lists on the Australian Stock Exchange. Common mistakes, I've been through these as we've gone through it: overconfident, unrealistic, unwillingness to invest in the process, reliance on one existing investor, reliance on one potential investor with no time pressure. All these are common mistakes that companies make when they go through the capital raising process. So this is my belief for everyone, and we've now built a process, you know, to education, super important, right? You need to know you need to start learning what you don't know, right? Like anything, the more you can learn this process and master the capital raising process. If you're going to do a $5 million raise, it means that you don't have to pay away 6% of fees to someone to manage the process for you, right? Can be a massive cost saving just getting the education. Software is important, right? How you track and how you analyze it and how you set up your process will make such a difference to your conversion rate. So for example, we spoke with a company the other day that spoke with 50 investors and didn't convert one. So he's 0 from 50. So what's the point of him speaking to another 50 investors if he doesn't improve his process, or if he doesn't improve his offer, or if he doesn't improve what he's doing, right? The goal is if you're currently raising from, you know, if you speak to 50 investors and you raise from 1, then how do you raise, you know, how do you get that to 5 in 50 or 10 in 50 as an example? So analyze, refine, improve, repeat. The real goal that you're going for in this process, right, is the real process is confidence. That's effectively what you want to get to. Now, just as I'll give a quick little sort of highlight of CRIISP, and obviously we'll send out some information to you about this afterwards, but effectively what we've built is a process which actually utilizes all those different parts. If you go back to this, what we've now got is a process which can actually take people through the education, the software, the process, and also the investor attraction. Previously, we'll just focus on the investor attraction part, but everything else is just as important for us. The goal that we're going for is how do we help you raise capital with confidence? How can you actually utilize analytics to increase your conversion rate with investors? You absolutely need to save time because it can become all consuming. And then how do you actually reduce your opportunity and revenue? How do you reduce opportunity cost and the impact that it has on your revenue? Now, the final part is we provide to all our clients the templates that they need for that process. So I'll send out some higher level information afterwards. And if anyone has any questions, I'm happy to sort of provide a bit more information about that. But for this, I just want to keep it as educational as possible. The main thing I just want to leave as a final thing before I hand it back to Ron is become familiar with this process. Understand it's going to be an emotional roller coaster, but getting good at this process will mean that you never have to rely on anyone else to do this for you. It is actually sad how many companies I see hand over the confidence of their capital raising to people that don't have anything on the line to actually help them raise their business. That is one of the best things that you can do for your business. It will help you. And the actual pitching process will help you in so many ways that you don't currently know, whether it be the strategic structure of your business, understanding directly what the investor feedback is. All that stuff is super powerful, right? And we highly recommend companies, and founders learn this for themselves. So on that note, there's my details. Please add me on LinkedIn. I'm always sharing information on that. My email's up there, and obviously we've got some information on the CRIISP site for that. Back over to you, Ron.
Thanks, Steve. If you can just return the screen and we'll have a chat. So once you on the screen as well, we can do that.
There we go.
Very good. Excellent. So a couple of questions did come through. You've already answered one of those. So obviously there's IP in your deck. So so we won't be disseminating your PowerPoint deck with the IP, but obviously we'll provide a cut down version for those on the call.
Correct.
The other is the other question was asked, was this being recorded? Yes, it is being recorded, and we'll put the recording on our AIIA Behind the Wall website for our members there. If you're not a member, then obviously think about becoming one. I have another question though for you, Steve. You talked about it's a buyer's market now. What is the market going to look like beyond COVID-19?
Interesting. So something that someone brought up to me today is that you've got VCs out saying that, oh, we're still active, we're still looking at opportunities. If you can find me one venture capital firm that has invested into a company that they've never physically met with, I'll be really interested to hear that, because I haven't come across that many just yet. So to me, what's going to happen is this space is going to shrink, but the companies that do well in this market will effectively become the superstars that investors are looking for in this, in this period going forward. Because if you can grow in this period, or if you can raise money in this period, you're sending a signal to the market about your potential to operate in what is one of the most challenging times that we've ever sort of experienced.
So the other question I had for you that came through was, a customer comes to you.
Yeah.
What makes a good customer in your eyes?
So some of the factors that we're looking for in a company are really marketability factors. So we're looking for a board of management that have that sort of been there, done that experience, right? And that's helpful for any company that's raising money. We're looking for a company that's in a sector that's growing. Obviously, being most of the people on here will be in the technology sector. It's the top of the list for us and has been for some years now, as far as from an interest perspective. If you're a B2C business, you need to leverage off growth rates, right? So we're looking for what sort of growth rates can they sort of identify. If it's a B2B business, we're typically looking for blue chip customers. And the reason being is because they would have gone through some sort of procurement process as part of that. If it's a more technical business, we're looking for industry awards. and also even government grants as well is also a good signal for us. And then the last one that's of interest to us is investors. Who else has done DD on that company and put their own money on the line to come in? And obviously, of course, the founder's own sort of stake in that business as well. We've lost you, Ron. You're on mute.
I did do that to myself. Okay, so Steve, thank you very much for your presentation. I'm sure that everyone found that extremely useful. I want to make sure of that though, so I am going to send out a poll in a moment. We are really interested in your feedback. But for everyone here, thank you very much for attending. We are running these on a weekly basis, so we're going to ask you to go back to the website and keep up to date with the event schedule and the event program as well. What we're also looking at, we know that that networking is really part of the experience. So we're going to provide some other ways for people to come together, network, and have conversations around the topics that our keynote speaker has been talking to. So we would encourage you to also get involved in that part of the networking opportunity that we provide. Otherwise, I committed to finishing on time. Steve, thank you very, very much from everyone at AIIA. Really appreciate you getting involved. And for those of you who aren't members, now is a very good time to consider that, because there'll be a whole lot of other offerings, including some of the stuff that Steve's been talking to. So we encourage that as well. From us, thank you very much, Steve. Thank you very much. Goodbye, everyone. Please complete.
Thanks, Ron. Thanks to the audience.